Sometimes no news is good news, and when the Reserve Bank of India decides to maintain a very dovish stance, a very accommodative policy, when the world's central bankers are looking at raising rates, it's very good news, at least for the markets. For the 10th consecutive policy announcement, Governor Das this time round announced that the rates will be left unchanged. The MPC has decided to continue with its accommodative stance. Now, what does that really mean? What does that mean in terms of the Reserve Bank's outlook on inflation? Is inflation not as big a worry as we thought it was? If you look at what they have projected for growth in this fiscal year, at 7.8%, it's a drop from the current fiscal year. Why is that? Are we expecting rocky weather, even though the Omicron is behind us, for this year to come? So we're going to talk about some of these issues today on the show as we discuss the outcome and the implications of the MPC announcement. Joining me to do this is Abheek Barua, Chief Economist at HDFC Bank. Kaushik Das, Chief Economist, India Deutsche Bank, is joining us on the show. And Rahul Bajoria, Chief India Economist at Barclays, is also with us today. So welcome to all of you, and thank you so much for speaking with us. Let me start by getting Mr. Barua's point of view. Were you surprised that the reversed repo rate was not brought back towards normalization as was largely expected?
I, for one, was not surprised. I thought they would. I got a sense that the RBI views any change in the reverse repo rate not just as a mere technicality, but as a rate signal which is perhaps just as important as a repo rate hike. And given the myriad concerns, and there is currently a trinity of them, of growth, which is far from broad-based, and there can be questions about durability. Inflation, which they might have been optimistic on, but which is certainly on a downward trajectory to the extent that we can predict inflation at this stage. And the challenge of managing a humongous government borrowing program that lies ahead, I thought a signal, a policy change signal, which the reverse repo rate hike would have meant, was not what the doctor ordered, especially since they have managed to push up short-term rates, and the effective repo rate, reverse repo rate, which the governor referred to, has actually gone up by 50 basis points. So without sending too disruptive a signal, they have achieved to do a lot of things at the short end of the curve. And if indeed they view the reverse repo rate hike as an important policy signal which embeds in it a change in stance, perhaps this wasn't the right time to do it.
Let me ask a very simple question. Rahul Bajoria, let me come to you with it. Before this policy announcement today, the conversation was centered a lot about inflation. Concerns about inflation, crude prices have now been steadily climbing. They will begin to be passed on at some point. Perhaps after the election, you will see another round of increases of petrol and diesel at retail levels. But the Reserve Bank doesn't seem to be as concerned about inflation. How do you look at that?
So, Tamanna, I think the story really comes down to, the details of what's driving inflation. I mean, this is something we have been writing about for the last few months, that, in 2021, the bulk of inflationary impulse in India came from imported price sources, right? So as crude oil became more expensive, as palm oil became more expensive, as we saw fertilizer prices go up, there was quite a bit of shock coming from there. But the domestic price sources like food, even some of the wage price signals were reasonably benign. And I think the RBI's view is that, barring any major domestic supply shocks, right, we cannot know what happens externally. But domestically, if there are no supply shocks, the pace of recovery is not strong enough to effectively drive up domestic inflation materially. And while, we will probably see a bit of a mean reversion, as we have seen with food prices recently, but it's not going to be enough to trigger a scenario where the inflation is likely to remain sticky at the upper end of the target, right? I mean, so I think the broad trajectory, as Abheek said, is going to be one which is sloping downwards, and that gives them an element of comfort at the moment. Oil prices definitely are likely to go up, at the end of the election cycle, but then that also only adds maybe about 20 to 30 basis points to the headline number. So it's not going to be a complete shift in the trajectory, right? It might alter it a little bit, but not a complete game changer, at least, given where the prices are right now.
The question truly is that what are the signals that are coming out from what the Reserve Bank has said today? And let me come to Kaushik Das on this. So we're continuing with an accommodative stance. Is it also telling us that this is the position that will be taken for some time now, that while the rest of the world is laying down a trajectory for increasing rates, we are not going in that direction for some time? Would that be an accurate reading?
So, Tamanna, first of all, it's very clear that RBI wants to support growth at this stage. And Governor Das mentioned that it's not fiscal policy versus monetary policy. It's a complementary kind of a policy. If fiscal policy is trying to support growth, monetary policy will also try to support growth. And this will continue for the time being. And we are going through the third, wave. The numbers have come off, but still there could be some issues, going forward. So RBI has decided to kind of, be a little bit more cautious on the growth-related issues, and therefore have decided probably this is not the time to raise the reverse repo rate. Now, we were thinking that reverse repo rate would be increased by 20 basis points simply because the market interest rates are already higher than 355, and if RBI would have increased the reverse repo rate, probably it would not have that kind of an impact. But as Abheek said, I think it makes a lot of sense. I think RBI sees reverse repo rate also as kind of some bit of a signal that if reverse repo rate were to go up, immediately markets will say then the next move will be on repo rate. So in a way, not hiking the reverse repo rate also kind of signals that the repo rate will be hiked with a delay. And market is pricing in more than 125 basis points of repo rate hike from June onwards, back to back. Probably, not doing the reverse repo brings down that expectation of the quantum of repo rate hike. And that way RBI is managing the expectations of how much the repo rate can go up in this particular year. We think RBI will eventually hike the repo rate, probably from June, and then one more in October. But that will be just 50 basis points of repo rate hike, which will be 4.5% by the end of this year. Whereas market was pricing in before this policy repo rate going up to 5.25 by the end of this year. So that is how probably RBI is managing. And if I can just take 10 seconds or 30 seconds to explain the view on inflation. I think first of all, RBI is taking a call that oil prices will not be at 90 2 months down the line. And it will be somewhere around 70, 75 when the geopolitical tensions come down. So that could be one reason. And the second is if it stays high also, then probably the government could consider cutting the excise duty on petroleum products to some extent. So maybe it will not be passed on to consumers. From that standpoint, I don't think, inflation, the projection that they've given, they're kind of taking that into consideration that oil prices will come down. And therefore, they are given a lower trajectory.
All right. Abheek, do you agree that the rate hikes will begin from June, but maybe the quantum will be lower than expected? That's the reading coming out of this policy?
Not necessarily in June. There might be, we were penciling in 2 rate hikes. Sometime in the second half, depending on how, as just to sort of take off from what Rahul said, that if there is some sort of sign of durability in growth, which would manifest in domestic inflationary pressures strengthening, and the RBI recognizes that, only then would we see some kind of policy rate move, it would perhaps start with a reverse repo rate hike and then, go on to repo rate hikes. And I think, Kaushik is also spot on in the sense that the RBI got this, feedback or takeaway from market expectations that, the expected trajectory of rates was a little too high for comfort, given both growth concerns as well as this, challenge of managing a very large, government borrowing program, which again is, it's not just being the, the manager, debt manager for the government. It has growth implications because, whatever you're expecting from crowding in through public investments could get crowded out if your rates move up too much. So in the first policy, you kind of signal that, easy does it for us. And given the difference in the underlying growth inflation dynamics, which the governor was very, very emphatic about, between us and the central banks in the West, who face a very, very different set of challenges, not only in terms of the levels of inflation, the deviation from the target rate, but also, as Rahul put it, the underlying dynamics, which is sort of a wage inflation spiral. There is no need necessarily to mimic them, and you could have lack of coordination in monetary policy. And clearly, he took the example of China, which is moving in the other direction. I think our problems are far less than China, but it is not as if all major central banks, well, one major central bank has deviated from that direction. And it could be argued that the Fed, having kind of pussyfooted around inflation for too long, is now kind of overreacting and going into a hyper-aggressive mode. Maybe they will have to sort of pare down their aggression going forward. So there are a lot of things on the table. I broadly think the RBI did what was right for this moment. And given the huge uncertainty going forward, I really don't think we can predict too much in advance and get too fixated on, well, is inflation going to be 4.73 or 4.96 or whatever. It's just the path which at this stage seems to be downward sloping.
Yeah, so the push is for growth, clearly. Now, let me talk about the GDP outlook that the RBI has pegged for 22-23 at 7.8%. Rahul, Bajoria, do you think this is indicative of a recovery from a third wave, which is beginning to show as the numbers go down, but a rocky one at that? It's not going to be smooth sailing in this coming financial year.
Yeah, so I think RBI has kind of taken some lessons from, predicting the growth outlook in the previous year, where they started off with a very high number and then, we were hit by the second wave. And so there were subsequent downward revisions. I think given where the recovery cycle is, particularly where consumption and investments are still below the pre-COVID levels, on a rolling basis, it is, I think, a pragmatic call to not be fairly boisterous about our growth outlook. So I think it's a reasonable expectation to, we have the same number of 7.8%, and there are risks which are balanced in the current environment. But our sense is that from a growth perspective, you would need to see material outperformance, right? So if 7.8 becomes 8%, I don't think that has a material impact on the RBI's thinking around growth, right? It will, even if it's at 7.5, it's not going to shift their broad assumptions around, the growth recovery cycle. But you have to really look for a consistent recovery, and the risks around those numbers have to come in, right? So effectively, the degrees of risks that are there have to start narrowing, and the baseline outcome has to become less and less. I would say the predictiveness of it needs to increase, and that's what we will be kind of looking at, which will kind of guide, as Abheek said, the behavior of the RBI is to put growth in the center, and then everything else follows, right? So if growth outlook remains reasonably robust, I think monetary policy is also going to respond accordingly over the coming 6 to 12 months.
All right. Kaushik Das, your outlook on growth, and what are you gleaning from what the RBI has said so far? Do you think that the support for growth will continue?
Yeah, so I think the growth forecasts are pretty realistic. They've given 7.8, which is actually lower than what the economic survey talked about, 8.5%. And if you remember, IMF has given a forecast of 9% for FY23. So relative to that, RBI's forecast is conservative, which is pretty realistic. Our own growth forecast is lower at 7.5%, simply because what Rahul said, you can have potentially one more wave, who knows, about this COVID trajectory. So, I've taken conservatively 7.5. Then there are, issues related to where does the oil price settle? Is 90 the new normal, or does it come down to 70, 75? That will have a bearing on, the private consumption expenditure, because if oil prices remain high, that will bite into, the real disposable income, and, that can lead to consumption expenditure slowing down. So that remains a key risk. Monsoon, we have to see after 3 back-to-back, more or less normal monsoon, how does that play out? So there are a lot of risk factors, and also we should not forget that the biggest central bank in the world is going to hike interest rates quite aggressively. So we don't know what kind of financial market movements that can happen on the capital flow side. So if you take all those into consideration, 7.8% is a pretty good number, coming down from 9.2, simply because there's a base effect. But if you look at RBI's forecast, they're taking 17.2% growth for April, June. And then obviously the base effect normalizes, you get lower number. So I think this year, if you get 9.2%, next year 7.5, 7.8, something between 7.5 to 8% seems pretty reasonable forecast to make at this point of time. And then we have to see whether the durability of the recovery, which Abheek talked about. Are you getting on a quarter-on-quarter basis sequentially? Are things improving? Are more people coming out and spending, or are we kind of having a stop and go kind of an approach as far as the economy is concerned?
Absolutely. So there is a lot left to unfold in terms of the factors that will impact the economy in the months to come. It's going to be tricky terrain. We don't know if crude prices will cool off, as the RBI is presuming that they will. Will they still hover around this 93, 94 and go up to $100 a barrel? We don't know whether there will be another wave. We don't know what the fallout will be of the Federal Reserve increasing rates. But as of now, the RBI has decided to back growth and not really worry too much about inflation, with the hopes that it will cool off. Let's see how that plays out. Thank you so much to all of you for joining us today.
Thank you.
Thanks. Thank you.